Good question.
I think yes.
Yeah.
So can you hear me from online? Please just give me a sign in the chat so we can know that we are all communicating well together. Can you also see the shared screen? Some sign of life in the chat, please. Thank you, Francesca, Anne, thank you. Okay, so we can continue. Now, you have had the opportunity to check the Moodle page and you have seen that we have posted 5 exercises about inventory. I have to warn you that similar exercises were included in the test in the exam last year. So these are all, I consider them all important exercises to cover today together, okay? So there are 5 illustrations. I prepared 5 Excel spreadsheets for each of them, so we can solve real time, and then we will upload the solved exercises in Moodle. And we will do like this. We will be organized during class in 4 different groups. And each group will try to solve one of the illustrations, 2, 3, 4, or 5. So I'm waiting for the others to come, and then we will be organized in groups. I will let you like 10 minutes for each group to try to solve one of the exercises that I will assign. I will not ask from you to show me the solution here, because due to COVID situation, you cannot for the moment touch the keyboard and or come to the whiteboard, but I just want to leave some moments, some minutes to you to start and to try to solve the exercises. What I found is that sometimes when you see another one solve something, you think, okay, it's easy, I can do that. But in the moment that you start trying for yourself, you encounter some difficulties and then you have questions. So I would like 10 minutes for you to try to solve the exercise, and then we solve it together. Okay, what I have shared in my screen is the first illustration. I consider them a very simple one, and therefore I will solve that for you. I will leave the most difficult exercises to you later. I'm kidding. So the first one, the first illustration, presents a company for which you have to decide which cost model you should use, which is more appropriate to be used. Now, this is a company, limited company, that manufactures, repairs, construct or build, whatever you may call that, luxurious and customized yachts according to specifics and requirements from selected customers. In its manufacturing assembly facilities, this entity can assemble up to 3 yachts simultaneously. The raw materials that are used interchangeably, that means that they can be implemented and inserted in each one of the yachts, of the finished products, are kept in the general warehouse because I can insert them in whatever product I'm building or constructing. Whereas the specific materials that are used only in certain yachts, according to client requirements, they are kept in a separate storage room, which is dedicated to customization of production. That is logical. So everything that will be used for all the finished goods is kept in the same storehouse, warehouse, and then the separate materials are kept separately. Dedicated storage space. What inventory cost model would be appropriate for inventory for this company? Now remember, this is something that I have written there beforehand to help you. Remember that we have 5 cost models. The unit cost or specific identification. We have FIFO method, LIFO method. This one is in red, just to remind you that this entity cannot apply LIFO method, being under IS2 that does not prohibits the use of LIFO method. The fourth one is weighted average and then base inventory. So maybe we can start with the solution. Now we know the general situation. We are constructing yachts up to to 3 in the same time. We have raw materials, which may be general or specific. We have a construction floor with docks up to 3 in the same time. And then maybe we have, or maybe we don't have, a warehouse for the finished goods. That depends if we are going to keep the finished yacht or we are going to ship and deliver directly to the customer. So think about that, and if you have some suggestions, let me know. I would suggest some steps to solve this situation. If you have any suggestions before me, please feel free to say. For me, step 1 would be. Yes.
Just to zoom a little bit because I cannot see anything from here. Just
Sorry?
to zoom a little bit, like.
Yes.
Okay. Yeah.
Still, you have all the exercises that are there on Moodle. They are uploaded like 2 days
又想
ago.
看到的话就看。
And I really encourage you to have a look at those exercises before you come here, okay? Of course, we will always put them on screen, but before you come, in order to have an idea. Okay, which may be step 1. I don't have any idea about step 1, so I was any idea how to approach the solution for this case? It's pretty simple and straightforward, but just to put some steps of having some idea what to do. For example, like say,
Step 1.
I would say step 1, identify an inventory. Why is that important? This is not a merchandising company that has only one kind of inventory. Instead, this is like a manufacturing company, and it may have one of 4 different kinds of inventory. Now, someone can say, wait, there were 3 kinds. When did they become 4? So we have raw materials, we have work in progress, we have finished products, and we have the so-called supplies, if they exist or are used. What are office supplies are things that are used in administration mainly. Now, for the moment, we are forgetting about office supplies. Let's focus in 3 types of inventory. The raw materials, so we have 2 kinds of raw materials. I really apologize, this keyboard, I mentioned it several times, it's not very easy to use. So we have 2 kinds of raw materials, general and specific, okay? Then what do we have? Do we have work in progress? What do you think? Is there any work in progress? Okay, this is the inventories that we are identifying. There are 4 kinds of inventories depending on the specifics of manufacturing and construction process in this company. We have general raw material, specific raw material. We have work in progress. That means every yacht that is being constructed at a moment of time. Every time that we go into the production facility, we may find something being built by that time that represents the work in progress. When you go to the facilities of every manufacturing company, when you go inside the production floor or the plant or the factory, everything that you find in there being produced, that is work in progress. Semi-finished goods, if you maybe know by that other name. Work in process, work in progress. Semi-finished products is the same thing. Something that has been initiated to be manufactured but not completed yet. Everything physically and simply put, everything that you find within the plant, within the production facilities, is work in progress. And then you have the finished products, the finished yachts. Maybe the customers are not able to retrieve the product immediately after it's being completed, so you just transfer that to another storage room, maybe this is not the exact word, to another dock, waiting for the customer to take or waiting to be delivered to the customer address, okay? So these are 4 kind of inventory, which would be a step 2 in this process. Okay, that is pretty easy as well. Define the cost model for each inventory. First, identify the inventories and then think which one of these 5 cost models would be the best to apply for each kind of inventory. Now, as we are here, probably it would be easier to present each of the inventory in form of a table, let's say. So I'm starting with general raw material. Then we have specific raw material. Then we have work in progress. And then we have finished products, finished goods. These are inventories. In the next column, we may specify the warehouse where we usually put them, and the last column would be used for the cost model, more appropriate. Remember that this is something that we are suggesting to the company to use, okay? So general raw material, we are being said that they are used and kept in the general warehouse. So we have a general warehouse for the general raw materials, okay? What about specific raw materials? We are said that they are kept in a separate storage room. Okay? What about work in progress? Where do we usually keep work in progress? Production floor or assembly facilities, as this is a special activity for this company. Assembly facilities, okay? This is usually the place that we expect to find the work in progress. And what about the finished products? Usually we have a separate warehouse in case we are waiting to be delivering these finished goods to our customers. So usually the place is a separate, considering this is a company assembling yachts and this happens to some dock spaces. So this is a dock assigned to finished goods or finished products, okay? Good, now we know which are the inventories, we know where we have these inventories, in which physical space in a company. Now the last thing is to decide what cost model is more appropriate for each of them. Just use your logic, what your good reasoning tells you, and what comes into your mind, please say it. It's more likely that you are right. General raw material, they are kept in the general storehouse. I can use them in whatever product that I assemble. What is the most appropriate cost model here?
Wait.
Unit cost?
No.
No. FIFO?
Maybe.
Yes,
Maybe.
why not?
Yes.
Maybe. I can choose FIFO method or weighted average method. If there are, this depends on how much data and calculation I want to do, but I can choose FIFO or weighted average. This one of these two is the most appropriate cost method. The specific identification is not appropriate, and also this base inventory, this is not appropriate because sometimes this method is used by those companies that have to keep minimum reserves to guarantee their long-term operations. Usually these are big companies that do not want to interrupt their procedures and operations because they may be dealing with difficulties like shortages of supplies and so on. This is not the case. I mean, this is not Toyota company producing thousands of vehicles each day, and so they have to keep some minimum reserves in case there is shortages everywhere. They have to keep some inventory. This is a special company. They wait for orders from customers to produce something. So base inventory is not appropriate. Good. What about the specific raw materials?
Unit cost.
Which cost model is more appropriate? Come on, this is simple.
Unit cost.
Okay? Unit cost. What did I do? Okay? So unit cost or specific identification is more appropriate for this other type of inventory. Specific raw materials will be used and inserted only in specific products. So it's better that I keep them separately and account for their cost in the appropriate product that I'm going to calculate the cost of. Okay? What about work in progress? Work in progress means it is an uncompleted yet. It has begun to be assembled, but it's not completed yet. Which is the most appropriate cost model to use? FIFA? Weighted average? Would I want to have a weighted average cost for two different yachts? One is really expensive according to the requirements of the customer. The other one is basic, very simple. Do I want to have average cost? Not really. I want to have a specific unit cost for each of them so I can charge each customer according to their own requirements and according to my expenditure. So again, the most appropriate measure or cost model to use is the unit cost. Again, we are assembling yachts here according to the requirements of the customers. That means that I will assemble the cost and I will charge this customer according to his requirements. If they have asked for very luxurious and expensive items, I will make sure I will charge this to his account. I don't want a weighted average cost of inventory here. I will use the unit cost. Each item of inventory will have its own cost. Each yacht will have its own cost accumulated and calculated. What about finished products? Again, if I start assembling yachts using the unit cost, I will finish with the same method. Unit cost again. Now you see, this is an example of a real company that uses different cost models for different types of inventory. What is really important for this company is to keep track of all the expenditure that they make for different yachts that they are producing for different customers. And therefore, they have to use a method of costing that helps them and allows them to properly record all the expenditure. And this method is the specific identification of the unit cost. Whereas regarding the general raw material like common paint to paint all the yachts, it's not necessary to keep specific identification for them. We just may use a common method like FIFA or weighted average. Okay? Any questions so far? Okay, then like we said, for the moment we are going to be divided. Thank you for the suggestions in the chat, everybody. For those of you who are following online, please have a look at the 4 remaining illustrations and examples. We are going to solve them in minutes. Whereas for you that are here in the class, we are going to be divided into 4 groups. Let's say that the 2 first desks over here, 2 girls and 3, so the 5 of you, please, you have to look at illustration 2. It is this one over here. Inventory cost assumption. This is very similar with the one example that we solved at class. Okay, now 25 girls. Ilaria, okay, together with Viola and 2 guys over there, so the 4 of you, you are the other group and you will see, you will check illustration 3. With 3 types of inventory, X, Y, Z, and applying the net realizable value model. Okay?
What we have to do, can you repeat again?
You will try to solve this example. You will try. Then I will make the solution, but you will try and see if you do that or not. Okay, so what we do next, okay? The last group, the 2 last desks, I don't know your names, you will, you have to work with illustration 4. Okay? Products A1 and B2. Yes? The girl in yellow. And your friends, hello. Yes, all of you are going to work with illustration 4. Okay? The 2 girls over here, do you want to join the group that is, okay, join the group here. Illustration 5 is for me. I will try to solve that. You will try the others. 10 minutes time. Try to do something. I'm here to help. Then we'll solve everything in Excel. But for the moment, please try to go over that.
亲爱的，你知道要看什么？在网上已经有了。
对，咱们那个题，记不记得？咱们那个 Moodle 上面的那个。
对。
说弄3的什么玩意儿 ？exercise 里面那个题。
OK。
Una mille tre. Gross profit. Sì, ha spiegato un po'. Fisco. Questo è all'IVA all'ultimo, questo qua. 1500. Perfetto. Sì, madonna.
The group that is working with illustration 3, just a reminder, you already know that, but remember that IS2 requires inventory to be valued as lower between cost and net realizable value. Okay? You have 2 cases. You can value the inventory as a whole, so X, Y, Z together, the total, or the other case is to value them individually. Okay? Just a reminder for you. Whereas whoever is working with illustration 4, a reminder, under IS2 cost of inventories include cost of purchase, that is direct materials, cost of conversion, so everything other than direct material that is invested during the production phase, and other costs necessary to bring inventory under current conditions and place. This is theoretically. Now, specifically, we will cover into that example. So maybe I think that we are ready to continue and begin with the solution. Okay? Are you ready, group 2?
Yes.
Yes. Okay. Continue
好
then.
高兴啊！
因为就这道题最简单。
We are at 1st of January. Excuse me. I know that you want to work more in your groups. That's pretty okay and very good. But we have to focus now and understand the solution of each one of the exercises. The second illustration that we are already having there is very similar to the one that we went through during the lecture, and therefore, with your permission, I'm going to walk through that very fast. Okay? So we'll have more time to discuss the other exercises. So let's start with FIFO method. The cumulative inventory in 1st of January is how much?
2.
The cumulative value is 2 multiplied by 600, so it is 1,000,
And 6.
1,000 and 1,200, let's say. So when we further purchase some other in April, the cumulative amount is 3, and the value is
1,900.
So it is the sum of what we already had in 1st of January plus what we purchased in 30th of April. Then we sell one item that makes the cumulative amount down to 2 again.
对
So now what is the value under FIFO method?
1,300.
What is the value? What do you think?
1,300.
So the value is 1,900, but we have we have disposed of one of the earliest units with 600. That is the remaining value. It is 1,300, right?
Yes.
Okay, so you purchase another item. You still will have, again, you will have 3 units, and then we'll make the value from 1,300 plus 800. The cumulative value will be 2,100, right?
Yes.
Okay. Now you sell 2, the cumulative balance is 1. How much is that?
800.
From the inventory value, 2,100, that you already have, okay, you are selling how much? You are selling 2 units. 1 unit at 600 from January 1, and 1 unit with 700 from 30 April. So the remaining value is 800. Another very simple way to decide this is to say, okay, under FIFO method, what I have left in inventory, only 1 unit, is the one that I lastly bought or purchased. That is, what unit did I purchase at the latest date? Here.
800.
This 1 unit here, this 1 unit is in warehouse, this is the value of that 1 unit. That means another way to make the calculation is 1 unit at 800 price for that, okay?
但是这个只能在
There are 2 different ways to make the calculation, that doesn't matter. Now, you have purchased another one, the cumulative amount is 2 units, and the value is 1,700. How is that? 800, the current value of inventory plus 900 what we are purchasing. Okay, so this is according to the FIFO method. What about weighted average? Okay, I'm just, with your permission, I'm just copying the structure
Excel 方面
except the cost, but the rest will be the same. We will
Yes.
add rows as necessary. So what is the value? It will be the same. When we are purchasing again, the 3 units will have a value of 1,900, again 1,200 plus 700, okay.
But now we need
Something that I need to do with every single new
to
purchase.
purchase.
This is the average cost of inventory that I have to calculate after each new purchase that we make under weighted average method. The new thing that you have to do, it is pretty similar with FIFO method, but something else that you need to do is that every time you purchase a new batch of products and you insert and input that in the warehouse, you have to calculate a weighted average cost, and the weighted average is the ratio between total cumulative cost with the total cumulative cumulative units. Okay? Okay. So again, the ratio between total cumulative cost with total cumulative units every time. This is the formula, we applied it here, and we receive this cost of inventory. Now, this means that when I sell 1 unit over here, the cost of sale is 633, and also the cost of the remaining inventory will be the same. That is, right here, we will calculate 2 units multiplied with 633. Okay, so this is the cost at this moment in the inventory. Any questions so far? Okay. We come at a later date, we are purchasing another unit. Every time you purchase, the price will change. Weighted average cost will change. So 3 units over here, how much the cost will be? The current value is 1,267 plus 1 item that I'm buying for 800, so I will have here 2,067. So the sum of these two different costs. Now, as I have purchased, I need to calculate the weighted average cost again. Again, the division, the ratio between total value and total units. So every time the formula is like this. You divide total cumulative value with total cumulative units after each purchase. Okay, so now you see that you have an increase in the weighted average cost of inventory. And this reflects the trend of increasing costs of purchase over here. You have ever increasing purchase prices from 600, 700, and so on. And this is going to be reflected in the weighted average cost, because every time you buy something, it will come in with at a higher cost. Okay, now that you sell 2 units, of course you will sell them with a price 1,100 per unit, but what is their cost? Each of these units will be sold with 689, whereas the rest, the ending inventory, 1 unit that you have here, will have the same cost as the weighted average cost. So 1 unit multiplied by the weighted average cost, this is the cost of 1 unit in inventory. Okay? Now you are purchasing again. That is, the total cost of inventories will be the weighted average cost of 1 unit that you already have in your house plus the cost of the new batch or the new purchase units that you have buying till now. So it will be 1,589. Did I forget anything? Did I finish? Oh, okay, yeah, I forgot something. Every time you purchase, you recalculate the weighted average cost. Even though 30 November is the end of the transactions with this inventory, no more purchasing, no more buying. Remember, after 30 of November, it will come 31st of December, I will close financial statements. And I will get the weighted average cost of this inventory that I have in warehouse and how to calculate for that. The ratio between total cumulative value, 1,589, divided by 2 units that I have in inventory. So the value of the weighted average cost is, for the moment, this one over here. So you see again an increase in the weighted average cost. Why? Because we are experiencing an inflation in the prices of the inventory. Right now that we finished calculating the cost of inventory through both methods, another requirement of the exercise is to calculate the gross profit. Okay. So for the calculations of gross profit, we will start with sales cost of goods sold, which by the way is equal with opening inventory. I guess opening inventory will be 0, but still I'm just putting it there. Plus purchases, plus closing inventory, okay? Sales less cost of goods sold will provide the gross profit. And I have to show all this data for both, under both methods, FIFO and weighted average, okay? So let's start. Let's start with the calculations of sales. Remember that sales and purchases do not change under two costing methods. What changes is the value of the inventory at hand at the end of the period and the cost of goods sold, but what I have paid to purchase the inventory, what I have received from the sale of this inventory depends on the market. It does not depend on my choices on the cost model. So sales and purchases will be the same under two cost models. Let's start with them because they are the same. How much are the sales? In brackets over here, I will represent the calculations. You have sold one item with 1,000 plus two items with 1,100, right? This is the sales. Here we have the sales. If we gather the amounts together, we will find that the sales revenue is 3,200 for both methods, okay? Is that clear for everybody? Let's calculate the purchases. Again, the purchases will be the sum of 2 multiplied by 600 over here, right? The purchases are over here. Plus 1. If we add all of them together, if you push this button, you can see all the calculations there, okay? So again, sales and purchases are the same. For the moment, you may think that purchases are more than sales. Be careful, according to the matching concept in accounting, we compare sales with cost of sales, not sales with purchases, luckily. So let's discuss about opening inventory. That is easy. Opening inventory was 0. What about closing inventory? This is something that is already calculated in our cost model. The closing inventory under the FIFO method is 1,700. Why? Because I have 2 units as closing inventory. Under FIFO method, they are evaluated with the prices of the most currently purchased inventory. That means that these 2 units that I find in a warehouse are the one that I purchased here in 31st of July and the one that I purchased here at 30th of November. So 800 plus 900 again, the closing inventory is 1,700 over here. Whereas in weighted average method, I cannot do such a calculation because always I have a mixing of coming in newly purchased batches mixed with the existing inventory costs, and all the time I have a kind of weighted average cost there. This is the cost of closing inventory under weighted average method, 1,589. Okay, so the cost of goods sold FIFO method is 1,900 and the weighted average it is 2011. Whereas the gross profit, as we said, is the difference between sales and cost of sales. 1,300, 1,100. 189. Now the last question was something that you have to comment and interpret something. What happens, or can you make a comparison between two methods in conditions of inflation or increasing prices? What do you notice from this example over here? Any idea what to say? Now remember that this situation of increasing prices is very common in economies. Usually all industries experience slight increase in prices for all their inventories or raw materials. So this is a very common situation. In this situation, you can see that the FIFO method allows us to calculate a higher gross profit. Now, if we calculate a higher gross profit, this means that we will have to pay more taxes. And that is one reason why more and more companies that they find appropriate to, they choose to apply the weighted average cost method, because as you can see, taking into account the latest purchase prices, they can calculate a higher cost of sales, a lower gross profit, therefore reducing the amount of taxes that they have to pay. So this is why weighted average is becoming one of the favorite cost methods to be used by companies. Of course, it involves a lot of calculations, but as I said, this is done automatically by accounting software. Every time that you purchase new inventory, you insert the invoice in the system, and the system really updates the prices without any intervention. So this is something that happens automatically. Okay, I think we are done with the second exercise. Any questions? Any questions? Okay. We continue with the third
所以第二个
illustration. Now the floor is yours.
FIFO method increasing
Group three.
profit 会多一点
Thank you.
所以如果你想 pay less
选项
tax，
还是要
weighted average
Group 3.
So,
It's not difficult. In the meantime, the members of other groups, they have been focused on other exercises. You can have a look at the data. Group 3 had to deal with this kind of situation for a company that has 3 products in inventory, X, Y, Z. For each of them, we have the information about their cost and their net realizable value. Each of them. So we are required at what value should the inventory be stated in accordance with IS2. And then another question that we'll take later, not to overwhelm ourselves. Okay, any idea, Viola?
Okay, in accordance with IAS2, we took the lowest value of each product from between the cost and the net realizable value. And the sum we did is 151 because we did 34 for product X.
So, Viola, so you started with taking into account each inventory separately, not as a whole, right?
Yes, starting separately and then together. So it's 34 plus 65 plus 52.
Okay. Once again, please.
And then it's 151 totally.
So, as I already mentioned before, I wrote something. I used to require what Viola said, either as a whole, so maybe I can consider all the inventory together. This is permitted when the inventory is similar in nature. That is, if X, Y, Z are food or industrial products, not if X is a computer, Y is a bottle of water, and so on. In this case, I'm not allowed to put them together and value as a whole. But if they are similar in nature, a desktop, a laptop, and another thing, electronic thing, yes, I can value them together because they are impacted by the same technological changes and so on. So I'm starting separately to be more accurate. Valuing them separately means that I will track of the lowest between cost and net realizable value for each of them. That means that for X, I will consider which one?
34.
Okay, so I'm just bolding that amount. It's simple, I think. About Y, I have to take into account the net realizable value. This is lower than the cost. Of course, I have to expense that, or I have to write down into the expenses of the period this decreasing value, and we'll show that later. But for the moment, let's choose the basis of the valuation. And the basis of the valuation is net realizable value for Y. And Z, it is here. So, total cost of ending inventory will be 34 plus 65 plus 52 is equal to how much?
101.
151, and that's correct. Good. Now, what is the cost? What is the expense of the period? If we record the inventory with 151, right? What is the reduction in the value? And this reduction, remember, the decreasing value should be recognized as an expense in the period when we record this write down. So in this period, what is the expense that I have to recognize? 2. How did we calculate that?
We do the difference between the net realizable value from product Y.
Okay, so simply the difference from the one product that we made the decreasing value or zeroed down, the difference is 2, and that is the expense for the period. What is the accounting entry? I may ask that, but I will not. Just for you to know, I will not ask you in the exam. But what about the accounting entry? This is an expense. We should recognize that in the income statement, so in the result of the period. But how do we basically debit and credit the accounts? Anybody knows? Anybody has thought about that?
I'm going to decrease the inventory account for 2 and in the credit side, while in the debit side I have the expense, so the loss, the write down in debit side. Write down. I don't know I can call write down or loss.
Do not write this what I'm doing. I will not require this from you, but only for those who want to know more from accounting. I appreciate if there is any of you like that. If you are curious, how do we put that in accounting books, in journal and general ledger? What is the accounting entry? It will be like this. Loss from written down inventory will be debited with 2, and the credit inventory, or another way is to credit a separate account provisions to inventory. It's a contra account with credit balance. Whatever you choose is okay. I'm just putting that to inventory to have a shortcut over here. But if you choose to have a separate account, provisions to inventory as a contra account, like accumulated depreciation is for the assets account, that is also fine. And the value here is 2. Okay? Now, this is the first case. The second case is if you consider inventory as a whole, it means that maybe you have 3,000 items of inventory and valuing them separately is not useful, it's not practical. So you accumulate them together according to their classes and similarities, and you make a total value, total comparison between cost and net realizable value. That means that if I value the inventory as such, I would not consider them separately, X, Y, Z, and 1,000 items that I might have, but I will only consider the total. So total cost compared to total net realizable value, what will the total cost of inventory will be? The total cost of ending inventory will be the lower between cost of net realizable value. In this case, it is simple because total cost 153 is lower than total net realizable value, and therefore we choose 153. So total cost of ending inventory will be 153. No expense of writing down inventories. And in this case, we will have no reduction in the value or the cost of inventories. No expense in the income statement, and we'll just show in the balance sheet the value of ending inventory equal to the lower between both. In this case is the cost. Either cost of purchase or cost of production. 153. Okay? Any questions? That was pretty clear.
So we at the beginning, so we always have to compare the cost with compare. So for example, we choose the net present value. So we always compare
Net realizable value.
realizable value. So we always have to compare in the end with the cost,
Yes.
if it's loss or not.
Yes. Only with the cost. Okay, let's complete this one and let's go to illustration 4. The last group over there, you have the floor. If you can suggest something about this exercise, whoever decides to propose something. Now, in this case, there is an entity over here that manufactures two products, A1 and B2. There are two different products, and there is provided the data for the following. So we have this information provided over there. For each of the products, we have the direct material cost per unit. What is the direct material cost per unit is the amount of raw material that is invested to produce 1 unit of each of the product. This is, let's say, some kind of calculations that you have done previously, and this is provided already as data, readily available to be used. No need to put you into the trouble of calculating the direct material cost. The next data is to calculate the direct labor cost per unit. Again, behind these figures over there are a lot of calculations, but they have been previously executed for you. You should not go into the trouble of doing them yourselves. Then we have two different things, but we have to know the difference between them. We have normal capacity of production, expressed in units for both of products, and then we have normal capacity of production allowing for maintenance. Which is the difference between them? You see that consistently for both products, A1 and B2, the normal capacity that allows for normal maintenance of machinery is lower than the normal capacity. Anyone can understand the difference? Remember that when we explained the inventory standard, we said that normal capacity was like the medium or average capacity over the long term of operations. That means if in 2019 I produced or manufactured 10,000 units, and 2020 11,000 units, and then 2021 12,000 units, the average, which is 11,000, will be considered as normal capacity. But what is normal capacity allowing for maintenance? What does that mean? And is that important to consider here? Any ideas?
Minimum value, minimum sharehold,
Minimum
threshold.
Now, the normal capacity that allows for maintenance is a normal normal capacity that considers normal breakage or normal reductions in the production power that consider the shortages of employees, the shortages of breakage and running down of machineries and so on. It is normal during the production process that employees will not come to work, they will be absent. Also, it is normal that the machineries will be broken and need fixing. Allowing for these normal interruptions of work in the production floor means that we will take into account a normal capacity that allows for this maintenance and common repairs to take place. It is not real, it is surreal to assume that the working process will go on and continue without any interruption. That's not expected to happen actually. We usually expect normal interruptions and small stops in the working process. To allow for these interruptions, we consider the normal capacity that allows for this maintenance. Now, to be clear, IS2 considers and suggests that you allocate the cost of inventory based on normal capacity that allows for regular and normal maintenance. That means that you should take into account regular and normal maintenance, but not abnormal, not usual interruptions of jobs and works. If it happens that you have not normal or abnormal interruptions in the working process, that is going to be expensed as an expense in the period, but not divided or allocated among the inventory items. What I'm trying to say here is that you have 3 levels of productions. That is provided only to make you think which one to use. I have already stressed here in bold that the one that we should use is the normal capacity that allows for maintenance. What is the targeted or budgeted production? That might be really easy to understand, but just to mention as we are here.
We expected that we can.
This is something that I budgeted firsthand, but then I couldn't realize or couldn't produce that much because of different reasons. Targeted, budgeted, it's the same thing, but in any case, you see that we could not produce that amount. What is machine hours per unit? Sometimes this is a measure or an indicator of the using of infrastructure or using of resources in a company. We may use different indicators for resources usage, and these different indicators can be machine hours or can be direct labor hours. It means one product may be more complex and sophisticated than the other, and it may need more hours to be produced, more machine hours, more direct labor hours. In this instance, this company is selecting as a measure or as an indicator to measure usage of resources, the machine hours. You see that product B2 requires 5 hours, and therefore it is more complex and more sophisticated than product A1. Other things being equal, I would assume that as the second product requires more machine hours, it will be allocated more overhead expenditure. So I'm repeating once again. The machine hours, which is the indicator for resource usage, is going to be used to allocate the overheads, which are expenditures occurring during the production process. Normally, the product that uses more resources is the one that will be allocated more expenditure. Logically, the second product that requires more hours to be produced, it will need more expenditure, and this will be the basis of allocation for the variable overheads. Now you have some clarification over here. You remember what overheads were? Overheads are general expenditure that happen during the production process, but they are not either direct materials nor have direct labor. Usually overheads are items like electricity, maintenance, depreciation of machinery, rent, and so on. Some of the overheads are fixed costs and some are variable costs. Now let me ask you a very stupid question, I would say. Do you know the difference between fixed and variable costs? Okay, that may be stupid, but better safe than sorry. What is the difference between them? Because it is important for what we are going to do next.
Variable depend on the volume of production.
Very good. Variable relates to the volume of production. It means the more I produce, the more expenses I will have. Give me a simple example of variable overheads. Energy, good. The more I produce, the more energy I consume. That's a good example. And also some other examples of variable production are indirect materials and indirect labor. But still, you just have to think that variable overheads are directly and proportionally connected to the volume of production. The more you produce and manufacture, the more variable overhead you will incur, you will expense. Good. What about the fixed overhead? And to be honest, the majority of overheads are fixed, are not variable. Some examples of fixed overheads. Rent expenses, I pay rent for the factory. Even though I may produce 0 units, I still have to pay the rent. So it doesn't have anything to do with the volume of production. Fixed overheads are constant, are fixed at a certain level. Either you produce a lot or less, you will pay or you will incur the fixed overhead in the same amount. I gave the example of rent expenditure, rent for the factory. Even if you don't produce anything for that month because of COVID situation, you still have to pay the rent, right? Another example of fixed overheads, because majority there are fixed actually. Salaries of employee, Elisa, suggesting. Do you agree with her? It depends, and I would say the same. It depends on which employees they are. If they are employees that are directly connected to the production of the process, that is direct labor, it is not overhead, Elisa and the others. Whereas if we consider the salaries of other employees that work in the production floor, such as supervisors, if I pay supervisors or supervisors of production process, if I pay them with base salaries, it is a fixed cost. But if I pay them according to the number of hours they work in the factory, it is a variable overhead. So this depends, Elisa and the others. Let's take some more clear example. I mentioned rent, but another example is the depreciation of equipment. Even though I don't use the equipment, under straight line method of depreciation, I will recognize the same amount of depreciation each period. In one period, I may produce 0 units and still charge the depreciation. So this is a fixed overhead. Other examples of fixed overheads, there may be a lot. Insurance of the premises, the security of the premises, and so on. Actually, most part of the overheads are fixed and fewer of them are variable. Okay, now we have some information over here. Total fixed production overheads in total are 87,000 and they have to be allocated based on the number of units in a 1:3 ratio. That means that I have to take into consideration the volume, of course, normal capacity. The one that is produced in larger volume will have the larger part of overheads, but still I will apply this ratio 1 for the first product and 3 for the second product. Whereas the variable production overhead, it is simpler to allocate. They are 30,000 in total and they should be allocated on a machine hour basis. Remember what we said about machine hour basis. Machine hour basis was the indicator of the measure that we would use to allocate the consumption of resources from both products. And this is usually the only logical way to allocate variable overheads. For this company, machine hours are the most common and logical way to allocate variable overheads. Other companies may have other measures like number of employees or number of hours of direct labor and other measures as well. So let's start the necessary calculations. Remember that under IS2, cost of inventories include cost of purchase, which is direct material, cost of conversion. Cost of conversion includes everything, the standard says that, everything other than direct material that is usually expensed during the production phase. Now, here I have prepared something. What do cost of conversion usually include? So first, cost of inventories has 5 direct material, and cost of conversion will include what items? Who can tell me? I prepared 3 blank spaces for you to fill in. Yes, direct labor. This is straightforward. Thank you. Okay. The second item of cost of conversion, everything that is happening during the production process but is not direct material. One was direct labor, the other one is variable overhead, and the third one is fixed. The third one is fixed overhead. So these are the 3 components of cost of conversion. Also, IS2 says that we need to include, if we have, unless we don't have, we don't do nothing about that. If we have other costs that are necessary to bring inventory under present location and conditions, we have to include them. For example, if we have to pay special taxes for using a special kind of material, that should be included over there. But in this case, we don't have this third item suggested by IS2. And therefore, we just have direct material and conversion costs. Let's prepare like a table to calculate the cost for each of the inventories. A1 and B2. So, direct material, direct labor, variable overhead, and fixed overhead. Okay? So this is like a table that if we consider all of the items, we may be able to calculate the total cost for each of these specific items. So let's accumulate every one of the elements and items over there. About the direct material, we have the data over here, and I'm just copying them through formula. Direct material is 7 for product A1 and 6 for product B2. The direct labor, the same, we are just referring to the data. 5 for the first product and 8 for the second product. So let's start with calculating. Okay, I will make here the calculations. To allocate the variable overhead, we are told that we are going to use the machine hours for each of the products. So I have to divide 30,000 with the number of machine hours so variable overhead per unit will be equal with $30,000, the total amount, with total machine hours, where total machine hours are equal with, you see that we spend 4 hours to produce 5 thousandths of the first product, and 5 hours to produce 8 8,000 units of the second product. So we calculate the total machine hours, as I said, 4 multiplied by 5,000 units plus 5 multiplied by 8,000 units. So 20, it is 100. This is 100 total machine hours. Again, 4 multiplied by 5,000 units and 5 per hour per unit multiplied by 8,000 units. So 20 plus 40, sorry, this is 60. I apologize. This is 60 and not 100,000. My bad. Now variable overhead per unit, it is therefore 30,000 divided by 60,000 machine hours. This will give us $0.00 per unit. This is the amount of variable overhead per unit. Sorry about that. Okay. So we calculated the variable overhead for 1 unit of product, okay? And you can see that this is the basis of allocation without considering any ratio, like fixed overhead at this ratio 1 to 3. And considering this variable over here, we make the calculations for each of the products. For the first product is going to be 0.5 multiplied by the number of machine hours that this product needs to be manufactured. How many hours did it need? If we check, it is 4 hours of machinery over here, 4. And for the second product, it will be again 0.5 multiplied by 5 machine hours per unit. It is 2.5. Okay, as it is not clear, A1 is
by unit 应该写成 van hours，应该会更注意的。
okay.
但是它
It
它
is
会
explained
进去
here for
，per
everybody.
hour 就是一个
2 is the
或者是写 van unit van hour，
对
2 is calculated as 0.0
我就还是自己写。
for each machine hour. For the first product, I would need 4 hours. That means that each hour is going to be allocated 0.5. And 4 hours, it will be allocated 2. 0.5 multiplied by 4. Whereas for the second product, I will need 5 hours to manufacture. Each of the hours will be allocated $0.5. So 0.5 for first hour, second, and so on. For 5 hours, it will be $2.5 in total. Okay? And this is the way that we allocate the variable overheads to 2 different products. Is there a way to convince you that we did not make any mistake? Can we check if we are alright with this? Yes, there is a simple check or correct tool. If we multiply the amount of variable overhead for each product with their number of units, in total it should be $30,000. The total variable overhead, let's check. 2 multiplied by 5,000 units plus 2.5 multiplied by, I think it was 8,000 units, okay? Okay, so it is 30,000. We check that we have correctly allocated all of the variable overhead, that nothing is missing anywhere or somewhere. Okay? This was pretty easy. Let's start with fixed overheads. Now the basis of allocations for fixed overheads
是这个 variable
are
proportion
the number of units on a 1 to 3 basis. Okay? So this means that fixed overhead per unit will be equal with 87,000 $5,000 divided by the number of units in a 1-to-3 ratio. Now, what does that mean? This means that I will not just add together 5,000 units plus 8,000 units for the second product, but I will consider them into a ratio 1-to-3. That means that 1 unit of B2 product will be considered as 3 times as the 1 unit of 1 A1 product. So this is the meaning of 1-to-3 ratio. And how can we calculate that? Please allow me to do the calculations here because we have all the data there. This means that we will start with 5,000 units from the first product and multiply that with 1. This is the, let's say, the coefficient of importance given to this product, just 1. Whereas for the second product that has 8,000 units, the coefficient of importance, if I may express it in this way, is 3. And that is the basis of allocation, 29,000. Again, it combines together the number of units for each product in a 1-to-3 ratio. Look at the formula over here, it will explain everything. So we combine, or we weight every number of units with their importance, with their weighted average coefficient that the data has decided to give to each of the product. The ratio 1-to-3 is decided by the company. It may be 1-to-2, it may be 2-to-3, it may be 4-to-5, whatever. Each time that you have a ratio given, you will combine the number of units with that ratio. Do not write anything. I'm just assuming what if the ratio was not 1-to-3, but I'm just guessing 1-to-5. What would you do in this case if the ratio between the units was 5-to-6, not 1-to-3? What should we do in this case? When we calculate the basis of allocation, we would combine the number of units of the first product, 5,000, to the weight assigned to it, which is 5, and the number of units of the second product to the weight that is assigned to it, and that is 6. The basis of allocation would be 73. Okay, so always refer to the ratio of the number of units, but not in a 1-to-1 basis. So you cannot just add them together, but you weight them to their weighted importance that it is exactly provided for you as a ratio over there. Does that make sense to everybody? Of course, if it was me, I would not have done the exercise so complicated. It would have been easier, just 1-to-1 and just add the number of units together. But as it is provided as an exercise for you, we have to be very clear about the solution. Now, when we come here at calculating the fixed overhead per unit, it will be equal with 80,000 divided by 49. And if we make the calculation, I've previously done that, it is $3 per unit. Be careful, per unit per item. So this is $3 if we divide the overhead, fixed overhead, with the basis of allocation that we calculated by combining number of units with the specific ratio. We find that the basis for allocation is $3 per unit per item. This means A1, $3 multiplied by the ratio 1 will be equal to $3. Whereas for second product, this will be $3 multiplied by the ratio of 3. Remember that the second product has an importance coefficient of 3, and this is equal with $9 per unit. Now we put these items over here, 3 and 9, Okay? Again, you may check if you are correct, if you have allocated everything or not. How? You combine 3 multiplied with 5,000 units plus 9 multiplied by 8,000 units. And if you check here the same number, 87,000, you are sure that whatever you did here that may seem complex and difficult, still you didn't miss any dollars or euros somewhere, or any thousands of dollars somewhere. It is still there, it is allocated to the inventories. The total cost is simply the sum of 4 items: direct material, direct labor, variable overhead, and fixed overhead. So the cost per unit for the first product is going to be 17, whereas for the second product it's 25.5. Any questions so far? Anything to ask? Everything clear, I hope? Remember, the rules of allocation are very clearly expressed in the exercise. Any question from home? Please feel free to ask. Okay. Shall we continue with the other exercise? What do you think? Okay. So remember, the rules of allocation, variable and fixed overhead. Let me make a kind of summarization of this. The rules for allocating the overheads, variable or fixed, vary with each company. The IS2 allows us to allocate the overheads related to the normal capacity, allowing for maintenance. And usually the variable overheads are allowed to be allocated relating to the actual consumption of resources. What does this phrase mean? Actual consumption of resources means how much each of the products has required in order to be produced. In this instance, our company uses as a measure of resource consumption the number of machine hours. The first product requires 4 machine hours, the second one requires 5 machine hours, and then we use this as a basis for allocation. What we basically did was that we calculated the total machine hours to produce the 2 products in their respective normal capacity, and then we divided the cost, variable overhead, to the total machine hours, and we calculated that, you know what? We spend $0.5 for each machine hour, and the product that consumes more machine hours will be allocated more variable overheads, logically. That was pretty simple. Regarding variable overheads, once again, it will be allocated according to the actual resources consumption, being that machine hours, as in this case, or any other measure like direct labor hours, but basically it will be the same calculation. Just the name of the indicator will be different. Whereas the fixed overheads are a little bit more complicated because, as we said, they do not vary with the consumption of the resources or the number of the units. They are fixed. So I have to decide which is the basis for allocation. And this company has decided that for the fixed overheads, the basis of allocation is the number of units, but not in a 1-to-1 ratio. That would be simple. But in a 1-to-3 ratio. Why is this ratio? What does that represent? That represents probably the time that it takes to produce the 2 different products. Or probably that may represent the profitability of the 2 products. It doesn't matter in this case. What matters is that the company has decided the rules to allocate the fixed overheads. So they say number of units in a 1-to-3 ratio. Now what does that mean? That means that when I add together the number of units, I cannot simply add 5,000 plus 8,000, the sum of them. No, this is not correct. I have to consider the number of units over here in a 1-to-3 ratio. And that means that I will calculate them like this. If you can see, I hope you can see. 5,000 multiplied for 1 plus 8,000 multiplied for 3. So we apply this ratio to calculate the allocation basis. And then this allocation basis is used to calculate the coefficient of allocation, which in this case is $3 per unit per item. Okay? As A1 has a 1 coefficient, it will be 3. The B2 has a 3 coefficient, it will be 3 multiplied by 3, it will be 9. So we gather everything together in this table over here, and we see that the total cost of each product is in the last line. Okay. Let's continue with the last exercise. Okay, we have something in the chat. Elena has a question. Does overhead mean total? Yes or no? Elena is asking in the chat. Does the overhead mean total? No, Elena, it means, thank you for whoever is also answering. Overhead means general. What? It means just general expenditures. When we say production overhead, it is production general expenditures. Okay. We go on from here. With the last, you are welcome, Elena. So this is our last example. Let's look at the data over here. It's supposed not to be difficult. We have this data about one product only. This company that we are going to treat and explain, it only has one product in inventory. The data for the product is direct material cost per unit, so direct materials, direct labor cost per unit. This looks similar to the previous exercise, right?
Yeah.
Other direct costs per unit, what are these other direct costs per unit? Except for direct material and direct cost, direct labor, it may be direct expenditure that are possible to trace directly to each of the products. Okay? We have the cost of finished goods at the beginning of the year. We have production overheads per year. Again, the overheads are there to be used in calculations. We have administration overhead. You see here there are two types of overheads. Production and administration. Oh, sorry, there are three of them. And selling, which is the difference between them. Administrative, selling, production. Remember, overheads are general expenditure. Any idea which is the difference between the three of them? Any idea? Yes?
Yes.
Very good. As always, Viola. Very, very good. To whoever is very accurate when he answers, I will give you a bonus. I have decided. So keep going. I will not apply a negative bonus to who answers not correctly, so keep trying. You will not lose anything. You may have something. The area of competence. Yes, Claudia, you may put it like that, but actually the classification of general expenditure relates to the function. What is the company doing during their operating activities? Usually the companies try to do these three things. One, to produce the goods, then to sell it, and then to generally administer everything. So basically, during your daily activity, which is the operating activity, Inside operating activity, you can distinguish three main functions. The first one is to manufacture. The second one is after you have manufactured to try to sell or to distribute the product. And the third function is to administer everything. This is the general administration of the company. And normally you can also distinguish the general expenditure, that is the overheads, in each one of these three functions. Therefore, you have production overheads. Hello? I know that this is not so funny, so you are probably not dealing with overheads, but let's go back here. So, general overheads that we spend during the production are production overheads. General overheads that we consume during the efforts to sell the product, to deliver the product to the client, they are selling overheads. And all the general expenditure that we incur in our efforts to generally administer the headquarters are known as administration overheads. Some simple examples of each of them. Production overheads were rent, electricity, depreciation, and so on. Administration overheads are the salary of the accountant, the salary of the general manager, the salary of the lawyers of the company. Whereas selling overheads, some simple examples are the fee to deliver goods to the customer, the transportation cost, when you take the product to the final customer. So you see there are different expenditure, but the classification between production, selling, and administrative depends on what function are you serving to. Why are you doing those expenses? In order to produce, in order to deliver, or in order to generally administer everything, okay? Now remember that IS2 specifically requires to charge to the inventory only this one, only production overheads. IS2 does not permit, does not allow to charge to the inventory neither administration overheads, so I'm putting this in red, nor the selling overheads, I'm again putting this in red. The waste costs, this is in red as well, it is not allowed to be allocated in the inventory. Why? Because the waste costs are considered abnormal. And also the cost of storage of finished goods are not allowed under the IS2. Again, this is not allowed. I put this as a reminder for you. It's part of the slides of the chapter about inventories. IS2 is very specific what to allow or not to be included in the cost of inventory. Okay, why is that so important? Remember that by putting the cost in inventory or not, we may impact the amount of profit, and this is a serious thing for companies. If I charge some expenses to the inventory, and that inventory is not sold until the end of the period, that expenditure will not be recognized to profit, and therefore I will declare a higher profit and I will mislead the potential investors. That is called accounting fraud, okay? So this is why it is very important to remember this stuff. Now, waste cost, as you can see, administrative, selling, and storage are not allowed to be allocated into the inventory. Again, this is a accounting manipulation, accounting fraud. Also remember what we previously said, dear students. Variable overheads are to be allocated based on actual use of resources, actual capacity, whereas fixed overheads are used to be allocated under normal capacity. Now, there are two cases or two problems that may arise here. We may have actual capacity lower than normal capacity. Well, in these cases, so if we see that the actual capacity is lower than the normal capacity, the costs of unused capacity will be recognized as an expense during the period. Okay? How we do that, we will show in a moment. Whereas if we see that actual capacity is abnormally higher than normal capacity, the cost of inventories can be charged less, and therefore they can be lower than normal. Let's start with the current situation. As you can see by the naming of the sheet in Excel over here, this is the situation when we operate in under capacity. Why? Because you see the normal capacity is 100,000 units. Whereas for various reasons, during this year, let's assume it's 2020, the starting of pandemia, the actual capacity of production was not 100,000 units, but actually it was only 60,000 units. What will we do to allocate the variable and fixed overheads in this case? Now, I'm writing over here. Yes, I have 2 items of inventory costs. Okay, let's remember direct material, direct labor, other direct costs. What we have done here is that we have distinguished which are the items that we can include in the cost of inventory. What we have assigned with the red color are not allowed to be allocated to inventory. What is allowed is the direct costs, either material or labor or other direct costs, and also the production overheads. Now, we already have the direct cost calculated or given as a per unit basis. So no need to make any calculation there. The only calculation that we need to make is to allocate the production overheads in total, 100,000, to allocate them to the normal capacity. Remember, IS2 says that I have to be based the allocation of production overheads on the normal capacity. So production overheads is 100,000 and the normal capacity is 100,000 as well. Okay? So if we come here, direct material will be 2. Direct labor and other direct costs will be respectively 3 and 1. I'm just taking the data readily available here. I'm not doing any allocation for the moment. The problem is that I have to do some allocations here. Production overhead. And production overhead will be the ratio, production overhead per unit, overhead divided to normal capacity. Okay? So which will be production overhead 100,000 divided by the normal capacity 100,000. That is 1. Again, what we compared and applied here is the ratio between production overheads and normal capacity. Why we did that? Because IS2 very specifically requires to allocate the production overheads based on normal capacity. Beware, not based on actual capacity. You may have been working under normal capacity for various reasons, but you should not let the cost of unused capacity to be allocated to inventory. Instead, you will take into consideration the normal capacity instead. Okay? So this is the calculation that we do, and the total costs of inventory is going to be 7 per unit. So this is the total cost of inventory per unit. Very good. I have now to calculate 2 very important items for the closing of financial statements at the end of the year. Okay? Cost of inventory in the balance sheet and cost of goods sold in the income statement. Okay? Based on the cost of inventory that we have over here, total cost of inventory, we have calculated the total cost of inventory per unit to be $7. We base our calculations of our cost of inventory in the balance sheet and in the income statement, in case we may calculate them, based on this amount of data over here. Now, you see the question calculate the cost of inventories of closing finished goods in accordance with IS2. The closing finished goods, so the units of finished goods at year end, you see that there are 30,000 units. If you can see over here, so this means that the cost of inventory in balance sheet, it will be 30,000 units multiplied by $7 per unit. This will give us a final cost of inventory $210,000. Okay? So again, it is pretty easy to calculate the cost of ending inventory. Once we know the quantity, the number of units, it is provided in the exercise, and then we have calculated the cost per unit, which is $7 per unit. And then we calculate the cost of inventory, 210. Now, I'm not sure if we can calculate cost of goods sold because we are not provided with data for the number of sold units. Okay, we start with 20, we produce 60, and then we finish with 30. That means that we have sold 50,000 units. 50,000 units, so during the period multiplied with 7, this will give us a cost of $350,000 in total, calculated as cost of goods sold. Again, how do you calculate that we sold 50,000 units? Based on the inventory equation, we are starting at the beginning of the year with 20,000. We are producing or manufacturing 60,000. So 20 to 60, it is 80,000 units. If we are left with 30,000 at the end of the year, this means that we have sold the remaining. The remaining, it is 80,000 less 30,000 unsold. 50,000 units are sold during the period. What is also very important to emphasize here, it is what happens with the cost. What about the cost of unused capacity? What do we mean with the cost of unused capacity? Remember that we have allocated the production overheads not in 100,000 units, which is the normal capacity, but to 60,000, but to 100,000. So we have still $40,000 unallocated. Now this is the cost of unused capacity. The cost of unallocated production overhead. This is the cost of unused capacity. Whenever you hear this word, cost of unused capacity, this is the case in which we have unallocated production overhead. What do you mean by this? Somebody would say. Now remember that we have charged over here $1 per unit, right? We have charged $1 per unit. Okay? And we have manufactured 60,000 units. For each of them, we have charged $1. That means that we have recognized $60,000 as the inventory cost. $1,000 less $60,000 that we have already allocated to inventory. This will be leaving us with $40,000 cost of unused capacity that will be recognized as an expense in the current period under the item other operating of the income statement, of course. So again, if we allocated only $1 per unit, and we have produced or manufactured only 60,000 units, that means that we have actually allocated to the inventory costs only $60,000. But remember, we have spent $100,000 in production overheads. That means that the difference between $100,000, that is the production overhead actually incurred, and the amount that we have actually assigned to inventory, this means that $40,000 are going to be considered as expenses for the period, included in the income statement, under the item other operating expenditure, other operating costs. Any questions so far? So remember, if actual capacity is lower than normal capacity, you will use the normal capacity to allocate the overheads, and the remaining cost, which is the unused capacity or the under-allocated overheads, will be recognized as an expenditure during the period, as we are doing over here. Okay, what if we have overcapacity? Along with some more minutes, we will not take a lot of time. It's basically the same situation. I'm just assuming that the actual capacity, you see over here, it's not 60,000 units, but for one reason or the other, we have overproduced way more beyond the normal capacity. Is that even probable or likely to happen? Well, sometimes. Sometimes we may have such big demand from our customer that we may acquire extra capacity, and maybe we can produce in abnormal capacities. Then what will happen in these cases? Now, in the case we have abnormal capacity, I'm not repeating the calculations again, I'm just writing the rules here. In this case, the actual capacity will be used as basis for the allocation. So the IS2 says that if we have an abnormal higher actual capacity, we will use this actual capacity as the basis for allocation of fixed overheads. That means that $100,000, which is the total production overheads, they will be allocated to 100,000 units, giving us an amount of $0.625 per unit. Now, compared to the previous situation, when we consider the normal capacity, we allocated $1 per unit. Now we have a bigger amount, a higher actual capacity, 160,000 units, and therefore the amount that I will allocate into each one unit is lower, $0.625 per unit. Again, the calculations are, I hope, clear over here. That means that in this case, each unit will be charged with only $0.625 of fixed overheads, and the total cost of production per unit will be, remember in this case it was 6 plus 1, 7, but we allocate only 0.625 for each unit, it will be only $6.625 per unit. Okay? That means that cost of inventory in the balance sheet will be 30,000 units multiplied by 6.625. It will be equal with 198.750 if we make the calculations. Now, this is the cost of inventory in the balance sheet, and no, in this case, no expenses to be allocated in the income statement. Because in this instance, we have allocated all the fixed production overheads, we have allocated them in the production. We have no expenses left to recognize as an expenditure in the income statement. Okay, so this is the case of overcapacity. Please have a look again at home. You will have these exercises solved. Have a look at the rules that are suggested by IS2 and see for yourself how they are applied in two different situations. Okay? If you want to take something away from all this that we said, always apply the calculations into the higher amount. So I'm repeating, fix in your mind. Allocate the overhead into the larger amount that you have. If normal capacity is higher than actual capacity, use the normal capacity. If actual capacity is higher than normal capacity, use the actual capacity. So the highest value is always the one that you should use. In case you don't remember all the rules, remember this. The highest should be used. Okay? I hope that's clearer. Okay, we finished for today. Tomorrow we continue with lecture in the morning, tutorial hours in the afternoon. So see you tomorrow. Thank you for your sessions today. Okay? Bye for everyone who is online.
你说哪个东西是5000还是什么？对，只要是一个数字。